Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
And I'm Henning.
And I'm Ingrid. It's week 30 of 2026, and this week's story is Crude Crosses, Waters Recede.
Oil has crossed $100 a barrel. The conflict has expanded beyond the Gulf. Freight markets have finally softened, and Bangladesh is beginning to recover after weeks of devastating flooding.
Let's begin with the biggest development. The conflict is no longer just about the Strait of Hormuz, is it?
Not anymore. This week, the Houthis attacked 2 Saudi oil tankers in the Red Sea and threatened to blockade the Bab al-Mandeb Strait.
Which effectively creates a second maritime front.
Exactly. For months, the market has been focused on Hormuz. Now, another critical shipping lane is under pressure, forcing traders and ship owners to rethink routes once again.
And Washington responded quickly.
It did. The United States warned of military retaliation against any further attacks on commercial shipping, while diplomatic progress appears as distant as ever.
Oil certainly noticed.
It did. Brent crude climbed above $100 a barrel for the first time since May, before easing back below $98 by the end of the week. WTI also remained close to $90.
Even after that pullback, crude still finished the week around 10% higher.
And that isn't the only disruption.
Correct. Drone attacks also halted operations at the Caspian Pipeline Consortium terminal in the Black Sea, forcing Kazakhstan to reduce production. So now we're seeing supply concerns emerging from multiple directions at the same time.
Which means higher costs and greater uncertainty for shipping.
Precisely. Owners now face rising bunker costs, higher insurance premiums, and increasingly complicated voyage planning.
One area that did change this week was freight.
Yes, and that's an important shift. Last week, freight markets largely ignored the geopolitical tensions. This week, they couldn't ignore weaker cargo demand.
The Baltic Dry Index fell sharply, while Capesize earnings also moved lower.
That's significant because softer freight earnings can finally encourage owners of older vessels to consider recycling again.
Although getting those ships safely to recycling destinations is becoming more difficult.
Exactly. The willingness to sell is improving. The challenge is reaching the yards through increasingly complex trading routes.
Let's move to Bangladesh.
The humanitarian situation is finally showing signs of improvement. Floodwaters are receding, emergency shelters continue to close, and attention is shifting from rescue toward recovery.
That's welcome news after several difficult weeks.
Absolutely. Commercially, we're seeing encouraging signs as well. Chattogram port operations have largely returned to normal, steel trading is beginning to recover, and attention is now focused on the upcoming delivery tide window.
But there was another issue that caught the market's attention.
Yes, a tanker was sanctioned after arriving in Bangladesh, even after local clearances had already been completed.
That certainly raised eyebrows.
It did. The incident has made both recyclers and cash buyers much more cautious. Buyers are becoming increasingly selective, with stronger preference for bulk carriers and vessels carrying clean compliance histories.
How is India responding?
India actually strengthened its position this week. The rupee weakened close to another record low against the dollar, but local steel plate prices continued to firm as reduced cutting activity tightened supply.
And compliance is becoming an even bigger advantage.
Exactly. As Bangladesh becomes more cautious following the sanctioned tanker, Alang's ability to handle more complex tonnage gives it an increasingly important commercial role. India still offers the deepest recycling capacity, the strongest compliance infrastructure, and now arguably the widest door for certain vessel types.
Pakistan seems remarkably steady again.
It does. Despite higher oil prices, expanding regional conflict, and renewed pressure on Gulf shipping, the Pakistani rupee barely moved.
That's becoming a familiar story.
It is. Gadani continues to benefit from limited vessel availability and a shortage of scrap steel, helping keep buying appetite firm. Local steel prices edged slightly higher, and recyclers remain optimistic that government measures supporting construction could strengthen domestic demand once the monsoon season passes.
Finally, Turkey.
Very little changed there. The central bank held interest rates steady for a fourth consecutive meeting, while the lira weakened to another record low.
But Aliaga's position in the recycling market remains unchanged.
Exactly. Turkey continues operating within its specialist niche, serving primarily European and Basel-compliant recycling requirements rather than competing directly with the higher-priced South Asian markets.
Let's wrap up week 30.
The conflict has expanded beyond Hormuz, adding fresh uncertainty across global shipping routes.
Crude briefly climbed above $100 a barrel, while dry bulk freight finally began to soften.
Bangladesh is moving from disaster response toward recovery, with recycling activity gradually returning.
India's compliance advantage continues to strengthen. Pakistan remains steady, and Turkey stays firmly within its specialist market.
Crude crosses.
Waters recede.
Freight rolls over.
Yards prepare again.
That is the story of Week 30.
Thanks for listening.
We'll be back next week with more insights from the global ship recycling markets.